Maximize your wealth and minimize taxes with individual pension plans. Strategic financial planning for business owners and incorporated professionals. Thank you for taking the time to watch this video. My name is Sean Wilson, and I'm a certified financial planner and portfolio manager at Moraine Wealth Advisory. Our business is committed to providing comprehensive and personalized financial advice to each client. In this video, we'll explain how an individual pension plan can significantly increase the value and growth of retirement assets. The benefit to you will be a clearer understanding of how to utilize an IPP in your financial planning. An overview of the topics that we are going to talk about today. What is an IPP? The tax landscape, eligibility, the benefits, a supercharged retirement savings plan, risk mitigation, corporate tax deductions, estate planning, and a case study. The landscape for business owners and incorporated professionals. In 2016, the corporate tax rates peaked at 50.67%. This also had the elimination of the small business deduction multiplication that was implemented in that year. Major steps were also taken that year to change or improve the integration of both personal and corporate taxation. This is trying to effectively make it so that the business owner is indifferent between salary or dividends. Tax landscape for business owners and incorporated professionals. In 2018, new TOSI rules, or the tax on split income rules, came out that significantly reduced the ability to split income. Historically, splitting income was an advantage for small business owners as they could split income with spouses and their kids and lower their average tax rate. They also introduced the small business deduction grind, which is basically where as your passive income exceeds $50,000 per year, you're going to lose a bit of your small business deduction for every dollar that it goes over. Effectively, what this means is you lose your entire small business deduction by the time you generate $150,000 a year of passive or investment income. Now, if all these tax changes were not enough, the taxes on personal income also went up. Looking forward, there's plenty of speculation about how the significant deficits over the last 8 years and the ballooning national debt will be funded through tax revenue. Now, we will continue to hear speculation related to corporate and personal tax rate changes. On April 16th of 2024, the federal government released its budget that made material changes to the capital gains tax inclusion rate that will impact both personal and corporate taxation. On the personal side, the first $250,000 of capital gains will remain at the 50% inclusion rate, and then it'll increase to 66 2/3 for any amount over and above. On the corporate side, though, the capital gains inclusion rate increased from 50% to 66 2/3 for all capital gains. So how did business owners save for retirement in the past? In the past, business owners and incorporated professionals saved for retirement by accumulating retained earnings in their corporation or holding companies. This effectively became their pension plans. Business owners and incorporated professionals were then able to pay out dividends at a tax-preferred rate. Now, the business owners would flow money out as dividends to family members such as children and their spouses. Over the last decade, changes to income taxation at both the personal and corporate levels have all but removed most of the benefits that were previously available for business owners. Today, passive income earned in a corporation is taxed at the highest marginal rate in each respective province. In addition, when we have passive income that reaches $50,000 per year, the small business deduction grind will start to be applied. What does that mean? For every $1 over $50,000 of passive income, the small business deduction gets ground down by $5. Another key development over the last decade is the close integration of personal and corporate taxation. There currently is little advantage to taking dividends over salary. So how do business owners save for retirement now? With all the changes made over the last decade to personal and corporate taxation, the individual pension plan has become an even more attractive option for business owners and incorporated professionals. The individual pension plan has often been referred to as a supercharged RRSP. Now, the pension plan is designed to provide the richest defined benefit pension in Canada. The IPP helps business owners and incorporated professionals tax shelter large sums of money, mitigate risk, and also reduce corporate taxes. So now that we know what an individual pension plan is, let's talk a bit about how it works. Your corporation or your professional corp becomes the sponsoring company of the pension plan. The corporation will make contributions to the pension, which creates a tax deduction to your company or for your company. Those contributions are invested in an IPP investment account where these investments can earn tax-sheltered returns. Effectively, the money invested within the plan can grow without taxation of any income earned within the plan's investment account. When you transition to retirement and begin drawing a pension from the plan, the pension income is then taxed personally to the plan member. Who makes an ideal candidate for an individual pension plan? To qualify for an IPP, you must earn T4 income, which is required under the Pension Act. You need to be either a business owner or an incorporated professional. You also need to be at least 38 years of age and less than 71 years of age. And the reason for this is you can contribute more to an IPP as compared to an RSP when you fall within this age range. You should have a strong cash flow and the need for tax shelter. While needing a tax shelter is not a requirement, it is an added benefit as it provides increased deductions to your corporation. These deductions can reduce retained earnings in your corporation and help preserve your small business deduction tax rates moving forward. So now I would like to break this down further by discussing the 4 key areas for which an IPP benefits the business owner or incorporated professional. We will try to illustrate how these pieces can fit together, starting by diving a little deeper into the supercharged retirement savings provided by an IPP. Then we will touch on corporate tax deductions, as well as estate planning, and lastly, risk mitigation. A supercharged retirement savings. So earlier I mentioned that an IPP is often considered to be the supercharged RRSP, or retirement savings vehicle. Now let's see how this works. On this slide that you can now see on the screen highlights some of the key differences between an RRSP contribution versus an IPP contribution. It is clear that there is an advantage both in terms of real dollars and in terms of percentage terms. The contribution for both the RRSP and the IPP assume that the individual met the maximum required T4 earnings of $175,300 in 2023. The benefits of an IPP become pretty apparent as early as the age of 45, where IPP contributions are $5,940 greater than the RRSP. With each year that passes, the contribution room into the IPP becomes greater and greater over that of the RSP. These annual payments are considered current service costs, and current service costs is really the increase in the present value of the pension obligation resulting from the plan member's existing service. Note, in most provinces, the business owner has the flexibility not to fund the pension obligation every year. And the reason I bring this up is that I think it's extremely important for business owners to understand that there is some flexibility which can be very helpful when it comes down to trying to manage your business from day to day or year to year. Past service costs. The amount of this transfer will be determined based on the calculations provided by the actuaries. It will take into account how many years you have been an employee and what you have paid yourself by way of salary. In the example on the screen now, you can see how an individual who had a high income for years and maxed out the RRSP contribution can have a sizable past service funding room to create a meaningful deduction for their corporation. One of the ways an IPP can provide additional funding to the pension is through what is called terminal funding. Terminal funding provides what is effectively a present value calculation to top up the pension for indexing the pension for inflation, as well as providing a bridge pension until age 65. It is not uncommon that these terminal funding amounts can amount to potentially 7 figures. This can become incredibly handy when business owners are looking to ensure their business has been cleansed from a tax perspective, when succession planning or a sale of a business is being worked on. Again, it is important to note that terminal funding is your option, and you will be able to determine what makes the most sense for your situation based on your details. We've covered how an IPP creates additional savings room for the business owner or incorporated professional, and now we're going to talk a bit more about how an IPP can reduce your risk. One way an IPP reduces risk is by providing a level of creditor protection. The assets of the individual pension plan are held in trust and are not on the corporate books. While I hope most individuals will never have to actually worry about this risk mitigation feature, it is still worthy to note. Another interesting aspect is that an individual pension plan can top up the funds if the returns are below the 7.5% assumption prescribed by CRA. It is important to remember that this is possible, but it does not make it an obligation in most provinces. Risk mitigation also comes down to diversification. Individual pension plans can hold similar investments to those in an RRSP. However, there are some rules about concentration that prevent an IPP from holding more than 10% of any single security. Lastly, I think it's important to mention that individual pension plans are nothing new. This retirement savings vehicle has existed for decades and has long been the gold standard. Corporate tax deductions. As business owners or incorporated professionals, we all love our corporate deductions. The great thing about an IPP is that everything is deductible. So, what deductions are available when you have an IPP? All your contributions are deductible. This includes your current service, your past service, top-ups, and terminal fundings. In addition to all these contributions being deductible, the actuarial fees that are charged annually are deductible, as well as the advisor fees with respect to fee-based accounts. It is also worth mentioning that advisor fees for fee-based accounts are not deductible for RRSP accounts, but with an IPP they are. You can start to appreciate how these deductions over time continue to grow in size and allow for a reduced tax to the corporation and deferred taxes on the investments that grow tax sheltered, which all helps accumulate a larger pension or investable wealth to carry you through retirement. Estate planning. One of the interesting things that an IPP offers business owners is that in a family-run business, you can have children set up on the same IPP as their parents. This becomes incredibly attractive in multiple ways. For one, it creates additional tax deductions for the corporation and retirement security for the children. An IPP has the potential to have no taxable disposition of the IPP assets upon the last death of one of the parents. In order to qualify for this, the parents would need to be drawing down their pension at the time they pass away, and the adult children would continue the business and earn T4 income. This tax-free rollover or disposition can amount to a material tax savings on the last death of a parent, avoiding a full income inclusion on their death. Retirement options. Option 1. The plan remains active and the pension is taken directly from the IPP. The IPP provides the annual income to the plan member, and the plan member or business owner has the opportunity to make the company make additional contributions by way of terminal funding or top-ups. Option 2. You choose to terminate the plan. In terminating the plan, the eligible maximum amounts can be rolled over tax deferred to a locked-in retirement account or LIF. The remaining amount over and above the maximum amount that can be rolled over is paid to the plan member as a taxable lump sum. So now let's look at this case study. This is a medical professional corporation, a single member plan age 55, incorporated for 10 years with employment income of $180,500 in 2024, and this member has $262,000 of RSPs. So right now I have a chart on my screen. Now you can see that over the years, the red bars representing the IPP and the blue bars representing the RRSP. The significantly larger bar in the beginning of the graph represents what's called past service costs. That's that lump sum that you get to put in at the beginning of the setup of your pension. And then each year thereafter, you see the increased contribution room that you create based on your earnings relative to an RRSP. In this second chart that you can now see on my screen, what we've done is we've illustrated how an RSP would grow from age 56 to 65 and comparing that to how an IPP would grow based on the increased contribution room provided by the IPP. The past service contribution created in year one created an additional $186,000 of contribution room over and above what the RSP would have been. From age 56 to 65, the net increase in contributions to the plan was a total of $415,100. The total impact of this is that the IPP ends up with a result that is nearly $700,000 higher than what the RRSP would be. That sums up what I wanted to cover today around how an IPP can help business owners and incorporated professionals build wealth and save taxes. If you are serious about retirement and reducing taxes, then book a meeting today. Secure your retirement with all the benefits provided by an IPP.